Most beginners don't lose money because they picked one bad stock. They lose money because they put their money into something they don't truly understand. Index funds, ETFs, mutual funds, and hedge funds may sound similar. They all involve pooling money. They all can invest in stocks, bonds, or other assets. And from the outside, they can look like different versions of the same thing. But they are not the same. Some are built for simple long-term investing. Some are built around professional managers. Some are flexible and trade like stocks. And some are designed mainly for wealthy investors who can handle much bigger risks. Choosing the wrong one may not feel like a mistake on day one, but over 10, 20, or 30 years, the wrong fees, the wrong strategy, and the wrong level of risk can quietly cost you thousands of dollars. So before you invest in any fund, you need to understand what you are actually buying. In this video, I'll explain index funds, ETFs, mutual funds, and hedge funds in plain English. No complicated finance language. No pretending that investing is only for people in suits. I'll show you how each type of fund works, how they are managed, what fees they usually charge, what risks they carry, and most importantly, who each one is actually for. By the end of this video, you'll understand which funds are usually better for everyday investors, which ones require more caution, and which ones are generally not designed for the average beginner. Give me the next few minutes and you'll understand a topic that many people hear about for years, but never fully understand. Before we begin, this video is for educational purposes only. It is not financial advice. Everyone's financial situation is different, so always do your own research or speak with a qualified financial professional before making investment decisions. Now, with that out of the way, let's start with the most basic question. What is a fund? Imagine you and 100 other people each put money into one big basket. Instead of every person trying to buy separate stocks, bonds, or real estate on their own, all of that money is collected together. That basket of money is then used to buy a group of investments. That is basically what a fund is. A fund pools money from many investors and uses that money to buy a collection of assets. Those assets can be stocks, bonds, real estate, currencies, commodities, or other financial products. The main benefit is simple. You don't have to buy everything one by one yourself. Instead of buying shares in 100 different companies individually, you can buy one fund that already holds many of them. This gives you diversification. Diversification simply means spreading your money across many investments instead of depending on just one. If one company performs badly, it may not destroy your entire investment because your money is spread across many different assets. But here's the important part. The big difference between funds is not just that they pool money. The real difference is how they are managed, what they invest in, how much they cost, how risky they are, and how easily you can buy or sell them. That is where index funds, mutual funds, ETFs, and hedge funds become very different. Let's start with index funds. An index fund is a fund that simply follows a market index. For example, an S&P 500 index fund follows the S&P 500, which includes 500 of the largest companies in the United States. Instead of trying to pick the best stocks, the fund just copies the index. So if the index goes up, the fund usually goes up. If the index goes down, the fund usually goes down. The biggest advantage of index funds is simplicity. They are usually low cost, easy to understand, and diversified across many companies. That means you don't have to choose individual stocks yourself. Most index funds are passively managed, so there is no manager constantly buying and selling to beat the market. The goal is not to outperform the market. The goal is to match it. But index funds still have risk. If the whole market drops, your fund can drop too. Also, many traditional index funds are priced only once per day after the market closes, so you don't trade them in real time like stocks. Index funds are usually best for long-term investors who want a simple, low-cost way to grow wealth without watching the market every day. Simple idea. Index funds don't try to beat the market, they follow it. A mutual fund also pools money from many investors and uses it to buy a group of investments. The big difference is that many mutual funds are actively managed. That means a professional manager or a team of managers decides what to buy and sell. Their goal is usually to beat the market. That may sound good, but active management often comes with higher fees, and higher fees do not guarantee better performance. Many mutual funds fail to consistently beat simple index funds over the long term. This is the part beginners often miss. Paying more does not always mean earning more. Still, mutual funds can be useful for investors who want a specific strategy, sector, country, or professional manager. But before investing, you need to check the fees, the strategy, the past performance, and the risks. Mutual funds may fit people who want professional management, but they are not automatically better than index funds. Simple idea. Mutual funds try to beat the market, but you pay more for that attempt. Hedge funds are very different from index funds and mutual funds. A hedge fund is a private investment fund usually designed for wealthy individuals, institutions, or accredited investors. Hedge funds often use more aggressive strategies. They may use short selling, leverage, derivatives, currencies, real estate, or other complex investments to chase higher returns. This can create big profits, but it can also create big losses. Hedge funds are also known for high fees. A common fee structure is 2 and 20. A 2% annual management fee plus 20% of the profits. That is much more expensive than most index funds, mutual funds, or ETFs. Because hedge funds can be risky, expensive, and complex. They are usually not built for everyday beginners. They may be suitable for high net worth investors who understand the risks and can afford large losses. Simple idea. Hedge funds chase higher returns with more complex strategies, but the risk and fees are much higher. ETF stands for Exchange Traded Fund. An ETF is like a mix between an index fund and a stock. Like an index fund, an ETF can hold many different assets, such as stocks or bonds. But like a stock, it can be bought and sold throughout the trading day on an exchange. That makes ETFs more flexible than traditional index funds or mutual funds. Many ETFs are low cost, diversified, and easy to access through a brokerage account. Some track major indexes like the S&P 500. Others focus on sectors like technology, healthcare, energy, bonds, or international markets. But ETFs still have risks. Because they trade all day, beginners may be tempted to buy and sell too often. Also, not every ETF is safe. Some ETFs use leverage or focus on very narrow markets, which can make them much riskier. ETFs are often a good option for everyday investors who want low fees, diversification, and flexibility. Simple idea. ETFs give you the basket of a fund, but the trading flexibility of a stock. Here is the simple comparison. Index funds are usually low cost, simple, passive, and built for long-term investing. They are designed to follow a market index, not beat it. Mutual funds also pool money, but many are actively managed. They may offer professional management, but they often come with higher fees and depend heavily on the skill of the manager. Hedge funds are aggressive, complex, expensive, and usually designed for wealthy investors or institutions. They can use strategies like leverage, short selling, and derivatives, which may increase both returns and risk. ETFs are flexible, often low cost, and traded like stocks. They can give everyday investors access to diversified portfolios with the ability to buy and sell throughout the day. So if we simplify it even more, Index funds are simple and steady. Mutual funds are manager-driven. Hedge funds are aggressive and complex. ETFs are flexible and accessible, but the best choice depends on who you are as an investor. If you are a beginner or a long-term investor, index funds and ETFs are usually the easiest place to start learning. They are generally low cost, easy to understand, and offer broad diversification. If you want a specific manager, strategy, sector, or investment style, mutual funds may be worth studying, but you must pay close attention to fees and performance. If you are wealthy, experienced, and comfortable with complex strategies and large risks, hedge funds may be an option, but they are not designed for most everyday investors. The goal is not to choose the most exciting fund. The goal is to choose the fund that matches your money, your risk tolerance, your time horizon, and your financial goals. A boring investment that fits your life is usually better than an exciting investment you do not understand. Because in investing, confusion is expensive. The more clearly you understand what you own, the better decisions you can make. If you want to learn how beginners can build a simple investment portfolio using index funds and ETFs, watch this video next. It will show you how people use these funds together to create a simple, low-cost, long-term investing plan. And if this video helped you understand the difference between index funds, ETFs, mutual funds, and hedge funds, make sure to like the video and subscribe for more simple investing explanations. Thanks for watching, and I'll see you in the next video.